And so before we get started, if you're interested in using the same broker that Mitch and I use, go check out TradeNet. They currently have a 30% off sale going on where you can get the intro account for only $350. And that's a huge deal because it comes with a funded account with 14,000 in buying power to trade with. There's also no PDT rule, and so new traders specifically can day trade as much as they want. And I think it's a much cheaper option for new traders when they first get started. The commissions are pretty cheap if you use small sizing. There's no PDT rule, and you're only risking what you pay for that account. And so it works like a prop firm, and if you want more information or if you're interested in checking that out, I'll include a link in the description. And so thanks for watching and enjoy this video. Alright, so we go through this quote here, and I think this quote definitely is one of the realest quotes in trading, which is, confidence is not, I will profit on this trade. That's not what confidence is. Confidence is not, I am going to profit on this trade. Confidence is, I will be fine if I don't profit from this trade. That is confidence. You know, confidence isn't winning on every single trade you make. That is not confidence at all. Confidence is, in fact, being able to accept it when you don't win on a trade. That is real confidence in trading. And I think most traders can relate to this quote. You know, it doesn't matter. Winning on every trade is not important. What's important is when you have losing trades, keeping it together and not making worse decisions. Okay? Losing trades are a normal part of trading. They are something that is going to happen to everybody. I don't care what people say. But the real traders that stick around are traders that can accept the loss and move on with their day like nothing happened. All right, and so like I said earlier, I think with most new traders, they lose their account in a very specific way. And this is usually what happens. And I know this from experience because this has happened to me many times. And only now am I finally getting better at not doing this. But this is one of the hardest things not to do as a trader. And this is what I call the snowball effect. And so like this says, it's very common for a new trader to double down their size after losses. What usually occurs is that they will take a loss in the market, maybe using too large of sizing than they should have been. And they are unable to accept that loss, and so they double down on their sizing in the next trade, attempting to win back that initial loss because they were using too big of sizing in the first place. Eventually, they'll lose again, and that loss will be huge, and now they can't possibly step away because their loss in their account is too big. And so they have kind of a mentality like, I just have to go for it, and I'll either lose my account or I'll get back to even. You know, and so they can't possibly step away now, and so they might as well take a huge risk and try to win back their losses since their previous losses were so big. If they lose on their next trade, their account is basically done. Like this happens, this is extremely common. And the reason I know this is because it happened to me. I've watched other traders do this as well. And so this happens. The point is this is very common. It's not just you, it's not just me, it's everybody. This usually happens, and you know, this will kind of get people's mind right. Like this says, it's a very common occurrence in trading. Almost all losses of accounts in trading are from this very thing. Even seasoned traders will fall victim to this occurrence occasionally. You know, this will happen to me sometimes where a good instance is I think about 2 weeks ago, on Friday 2 weeks ago, this happened to me. What happened was I took a loss. It was like a $30-40 loss, and instead of checking out, I decided to trade again, and I traded with bigger sizing the second time. And then that turned into like I ended the day down like $100 and something, you know. And so this happens to me too. Luckily, I recognized it, and I said I just need to take a step back and stop trading. But you know, it happens to every trader eventually, and most of the time it happens when they first start. But even very seasoned traders will have this happen to them eventually if they're not careful. Another thing to take from this, and the reason why this can be so damaging to accounts, is that many times, you know, certain strategies are simply not in play on certain days. So like many times, like for instance, like a lot of times the VWAP fade is just not in play on a certain day. You know, there's a bunch of fake outs for VWAP fades, and it's just not the day to trade that strategy. You know, And so even if you continue to attack that strategy, no matter how many times you do it, it's not going to work because that day is just not good for fades. For whatever reason, the market is not liking fades on that particular day. And so when you consistently keep attacking a strategy because you're frustrated or whatever, maybe that day is just not good for that strategy. And the best thing to do is just try again tomorrow. And so if you keep at it thinking, well, eventually I have to win, that's not necessarily true because certain days just are not good for certain strategies. And you have to recognize that. And so like this is, if you attack a strategy too hard on days like this, no matter how many times you double down and attack the market, you will a lot of times still lose. And this is why being able to take a step back and close it down for the day is a skill you'll need to learn. It really is a skill that you have to learn as a trader. And that learning happens by creating rules for yourself. This is something that you're going to have to condition yourself to do. And that's why most of the time this happens to new traders is because they just haven't had the screen time with real money in order to kind of develop that discipline in order to say, okay, I know I lost. I'm just going to take a step back. And we'll go over ways to condition that a little bit later in this class. But it is something that you'll have to learn. And it's another reason why, I think the more time you spend trading paper is great, but trading paper is still not going to give you that same level of trading that real money is. And this is the reason why, is because with paper, even if you're trying to emulate it as close as possible, and I think that's a good thing. I think traders should try to do that to a certain extent, but you also have to understand that even with paper, it's not going to be the same. You're not going to have that urge to rectify it immediately with paper. And so it's one of the reasons why I'm a big proponent of using real money, but using small sizing. Even if you end up losing your account from commissions eventually, I think using real money but with small sizing is important because you have to condition yourself to do this. And you're not necessarily going to be able to do that with paper. You can trade paper for a while, but when you finally switch over to real money, it's going to be different for you. It's still going to be different. Even if that difference is subtle, it's still going to be different for you. And so paper trading is great, but you also have to understand that it's a different world with real money. And so you want to approach it slowly. And, the goal is, it's one of the reasons why I think, people say Robinhood has some sketchy stuff and people talk bad about TradeNet, but both of those brokers allow you to use small sizing relatively well. And, especially with like Robinhood, for instance, like Robinhood, even though you're going to have to follow the PDT rule, with Robinhood, there's no commissions. And so you can literally buy 1 share, 1, 2 shares, 5 shares, 10 shares on Robinhood. And you're not really, you're not going to dwindle your account down from commissions. And so it's important, and this happens for a lot of new traders. There's a few other ways to do it, obviously. Another way is adding to a losing position. I've never really had that much of a problem with this one. I mean, I've done it before, and I'm sure when I first started trading, this happened to me. But a lot of new traders will add to a losing position, and for instance, like one example of this is like, say a new trader's trading, and they take 100 shares, and their trade is a losing trade. And so in order to try to change that to a winning trade, their initial trade was 100 shares. They decide to add 400 shares, making their full position 500 shares because they're trying to compensate for those losses that they have. And then that turns into a loss. And then they kind of do the same thing, the snowball, and that gets bigger and bigger. And one of the ways it can kind of start is by adding to losing positions. If they're having a losing trade and they can't accept the loss, a lot of times they're just going to keep adding to it, hoping they're going to win. And many times that win never comes. Scaling into a position is fine, but you want to have that plan beforehand. Like you'll see me sometimes, I'll get into a position and I'll say, okay, I'm going to take half sizing here just in case it goes my way early. But if it gets up to this level, I'm going to add this many shares. I'm going to add to full sizing. And so that way I'm not missing the trade if it goes my way, before it reaches my preferred entry. But I can still add and get my normal position size, right around where I originally wanted to. And that's the way you can tell if you're doing this out of frustration or if this is your actual plan, which is if you had that plan beforehand. The big thing to understand with these is that it may work at first. It may even work a majority of the time. But when it fails, it will fail big. And, this is there's a blackjack strategy, or no, a roulette strategy called the martingale roulette strategy. And the problem with this is that, you may even win a majority of the time with this strategy. But when you lose, you're going to lose big, and that's going to wipe out all of the gains you made prior to this. And so it simply does not work. Scaling into a position, if that is your plan beforehand, is fine. But being frustrated with a loss and then adding twice or triple your size just to try to make it into a winning trade is how you're going to lose an account. You're going to get so frustrated that what would have been a small loss turned into a big loss, and then you're just going to, quote, go for it, and you're just going to lose your entire account. So we can go on another way traders lose their account, is that they're just trading the wrong strategy. I talked about it on stream today. A lot of times traders get really invested in a certain strategy, and sometimes that strategy is just not working. But they can't hang it up because they've put so much work into developing the strategy. And it's really hard to be objective about it and say, okay, like I know I've invested all this time learning this strategy. I know I've spent all this time trading it and paper trading it. But maybe this strategy is just not working. And if it's not working, you got to be real. You got to be real about it, and you got to be honest with yourself about it. Because this will happen. Sometimes your strategy is just not going to work. Here's the thing. I used to really love pre-market high breaks. Eventually, I realized that pre-market high breaks, for me at least, they just didn't work for me. And it probably had something to do with the conditions or the way I was approaching the trade. But if I would have kept trading pre-market high breaks like I was, then then I would have just kept losing because something I was doing was wrong, and I was approaching either the strategy the wrong way or it just wasn't the right strategy at that point in time. And you have to be honest with yourself about it. So like this says, I'll go ahead and read this. Sometimes the strategy you're using and attached to is simply not working in the current market, or potentially ever. Backtesting is a crucial aspect of this and can help identify an edge in the market. Backtesting is super important. This is also why paper trading is crucial before using live money, because you have to find your edge in the market, and that takes time. It's one of the reasons why backtesting and paper trading are important. Because what happens a lot of times, another thing that happens with new traders is that there's a lot of content out there on YouTube and in the trading world, and a lot of it is teaching you all these different strategies. But sometimes those strategies are not going to work, no matter how you approach them. Sometimes they're just not going to work. So all the strategies I teach, I legitimately believe in, just to put it this way, if you use good risk and reward with these. But you still have to backtest these strategies yourself. Don't trust what I say. I'm just a guy on the internet. Backtest the strategy yourself, and then you'll really know. But what happens a lot of times with new traders is that they hear somebody teach about a strategy, and before testing it, before paper trading it, before backtesting it, they just trade with live money. And then the strategy doesn't work, and they're frustrated, and they think trading doesn't work. When really, it just wasn't the time for that strategy. Paper trade until you have found a realistic edge in the market. And depending on your risk and reward ratio, an accuracy rate of over 60% consistently is enough to profit in your account. And so it all depends on your risk reward ratio. I would say roughly 60% is probably the golden level, or the golden percentage. For me, it all depends though. If your risk and reward is typically 3 to 1, if your reward to risk is typically 3 to 1 or better, then you can get away with 50% or less sometimes. But in order to compensate for commissions and everything else, I think 60% is a good level. And again, though, it always depends on your risk and reward ratio. For instance, if your risk reward ratio is 1 to 1, technically you could be profitable with 60%, but it's still going to be pretty close. What I would do, and the way I kind of stick with it, is I usually look for at least 2 to 1 in most of the trades I take, and I'm looking to maintain an accuracy rate of 65 to 85%. That way I have 2 to 1 or better, and my accuracy rate is high, and so that is kind of how you approach it, and that way you'll be protected even if your accuracy rate falls down a little bit, because you're still consistently using good risk and reward. To be honest, your goal as a new trader should never be to make a lot of money. At least not right now. Your first goals for a new trader should be to find consistency. That should be the goal. And so, to break this down, you should focus on paper trading until you have a set system. We have a very set system. We know what market conditions we need. We know where we're setting our risk level. We know where we're setting our reward level, what our ideal risk and reward ratio is going to be. We know where we're going to take profits. We know what time frame we use. We knew when the best time of the day to trade it is, and we know everything about our specific strategy and our system. And that way we can keep everything consistent. You need to build your system up around a certain strategy. Where are you usually going to take profits? Where are you usually going to set risk for that strategy? How many, is it a scalping strategy? Is it a long-term strategy? How long are you typically going to hold on to the stock? These things matter, and you need to develop a system around the right market conditions with each specific strategy that you trade. A lot of times new traders, they simply just get into positions because they look good. They simply get into positions because they look good. They don't necessarily calculate range. Like this says, you should be able to teach your strategy, plan, risk and reward, and range calculation, etc. before moving on and using live money. This is typically going to take 2 to 4 months, honestly. Typically going to take 2 to 4 months for you to really come to your own as a trader and develop a system in place. 4 months is on the long side, and I would probably say you might be able to do it in a month or two. But you want to make sure you develop a system in order to attack the market, because that system is going to keep you accountable. You should always know when the best time frame or when the best time to trade is. I know mine is really after the first 5 minutes, within the first 30 minutes. That's kind of my sweet spot. Like for instance, today I traded at like 9:35 market time, and I was done by 9:40, 9:45, and then that was it. And that's usually my sweet spot. And every trader has one, and you can use TraderView to look up kind of when you have the best results. All right, and so here's another quote, really great quote in my opinion. The quote is, "You don't make money by trading, you make it by sitting. It takes patience to wait for the trade to develop, for the opportunity to present itself. Let the market come to you instead of chasing the market." Chart patterns are very accurate. They have proven their accuracy and predictability time and time again, but you actually have to wait for them to develop. And so again, this kind of shows sometimes you're just attacking the wrong strategy, and you have to wait for the right one. If you're using a certain strategy, if you've learned and mastered a certain strategy, sometimes you're going to have to wait for it. And if you get impatient and you start saying, well, I know this isn't my strategy, but I'm just going to attack this anyway because I don't really see anything that I like, then you're probably going to lose. And you have to understand that as well. One of the biggest reasons people are profitable as traders is their patience and selectivity and discipline. And so it's important to develop these things. And these are skills that you're going to have to learn. But they can be learned and they can be conditioned, and that's one of the ways that you really need to focus on and attack in the market is, understand that you're going to have to wait for the right setups. Sometimes the strategy that you have spent months learning and months paper trading is not going to be viable in the market today. And that's okay. And if it's not, and you don't see it in this market, there's nothing wrong with just observing the market. If you force it, if you say, hey, I've spent so much time learning this strategy, I have to trade this strategy today, even if it's not there, then you're probably going to lose. And that's something that you have to understand. I've always said, looking at my statistics in trading, on average, I do 1,000 times better. I know that's not really on average, but I do 1,000 times better on weeks where I actually skip a day. On weeks where I skip a day, I do so much better than on weeks where I trade every day. And the reason for that is because my mind is in the right place on the weeks where I can actually take a step back and not trade on a specific day. I know I'm more selective, I'm more disciplined in those weeks, and it reflects in my stats. I've kind of talked about what you need to do and kind of the mindset you need to have, but how can new traders really develop this mindset? How can traders really develop the right attitude, the right mental capital, the right mental game of trading? How can traders develop that? And it's simply done, as is most things in life, by repetition and conditioning. If you do something enough, eventually your brain will do it second nature. Eventually your brain will do it automatically, and you won't have to try so hard to do it. This is true with most things in trading, risk and reward, developing a plan. All of that stuff can be learned and really established in your mind and established for yourself in repetition and conditioning. Like this says here, repetition can help cure this to a certain extent by focusing on doing the right thing over and over and over again. It conditions your brain to keep from acting out fatal mistakes. And I'll say this again because this is super important. By focusing on doing the right thing over and over and over again, it conditions your brain to stop itself basically from acting out fatal mistakes. And so you have to do things over and over and over again. You know, there's the common saying that if you do something for 21 days in a row, it becomes a habit. If you do something for 21 days in a row, it becomes a habit in your brain, and you will do it out of habit. That's what you want to do with the right things in trading. It can take time in the market, which is why small sizing is crucial for new traders. Okay, so you're going to have to trade. A lot of times you're going to have to trade live money to really condition the right things in trading. And so that's why small sizing is crucial. That's why, extending your first account as long as possible is important, because you have to develop those positive habits in trading, those good habits. And so they can be reinforced through they can be reinforced a little bit faster through on-demand trading. So you can reinforce these habits, specifically risk and reward. You can analyzing range, stuff like that. They can be reinforced a little bit quicker through on-demand trading, but a lot of it is going to have to be with real money, because that's the emotional side, and you're just not going to be as emotional with paper as you are with real money. And so it's one of the reasons why you want to try to draw out your first account as long as possible. Keep that thing alive as long as possible, because that's the time when you're going to start to develop good habits, hopefully. And it's going to take time, and it's conditioning, and it's just repetition. In the next few slides, let's look at a few conditioning methods to help build good trading habits. All right, trade limits. This is one of the biggest things. If you want to improve your trading as a new trader, this is one of the first things you should do, is you should limit your trading. It's kind of ironic, isn't it? The best thing you can do to help your trading is to limit your trading. But it's so true. And if you have some experience in the market, you could probably understand this. Trade limits. You need to limit your trading. Giving yourself daily trade limits can help subside negative urges and better allow you to accept your losses. You got to limit your trading. It's also going to make it much easier to analyze your trading and figure out what you're doing wrong if you limit your trading. If you trade 20 times a day, it's going to be really hard to kind of pinpoint what you're doing wrong, except for over trading. But limiting your trading is huge here. And it's something that you want to understand and kind of establish, is that give yourself a trade limit. Like this says, though, it all depends on your style of trading. Everybody kind of wants to be the active trader that trades 5 times a day, because let's be real, that's the most exciting thing. It's really exciting if you're trading multiple times every single day. But many times, especially from new traders, they'll have the best results by limiting their trades each day and only trading a few times. This makes their trading easier to analyze, like I said, and pinpoint their mistakes. And so, of course, everybody wants to be the trader that can trade 5 to 10 times a day, and most of them are green, and they can kind of get really excited and kind of stay in and out of the market all day. But for most people, it's not going to be the most healthy way to do it. For instance, as you probably know already, I can only trade 3 times max per day. I literally have I've given myself this rule, and I've stuck to it. And so I can only trade 3 times max per day. And if they're both losses, if my first trade is a loss and my second trade is a loss, then I can't trade at all. I can only trade twice. This has helped my trading significantly and has made hanging it up for the day become much, much easier. Like this says, when I would reach my limit, when I first gave myself this rule, when I would finally reach my limit, when I would maybe have 2 losing trades, or I would have 3 trades total and it was a losing day, I would get really tempted to trade again and say, well, I could just take one more trade. I could just trade one more time, and it's okay. I know I have this rule, but I can just trade one more time, and maybe that'll be a winning trade, and I'll have a green trade for the day, and I'll be able to be happy I have a green day. But that is what can hurt your account. And so understand yourself, understand what's stopping you and what's causing big drawdowns in your account. And a lot of times it's you're not limiting your trades, you're just trading too much. Another good way to do it is redirecting focus. A good habit to get into is to do something you enjoy after a tough trading day. Like if you take a loss, go do something that you actually enjoy. That's what I do. When I have a tough day, and I have the urge to trade again, go do something you enjoy. Within a few minutes of doing something I enjoy, the anger and frustration has subsided and gone away, and I don't think about those small losses as much. They're not as big of a deal to me. I'm doing something I enjoy. What seemed so important and so frustrating and what seemed like a day ruiner, it's just not that big of a deal once you kind of take a step back and you redirect your focus. It also helps you to not force any more trades and better accept the losses you were previously stressing about, especially if you're having a losing day. I remember when I first started trading, I would take a losing day. I would have a losing day. I'd be down like $100, and I would try to go do something. And if I did something that would make me more frustrated, I would kind of walk back to the computer and say, you know what would make me feel better? If I had a green trade, if I had a winning trade. And so then I would trade again. And you could probably guess what happened. I would lose again. And so I was already in a bad mood. Now I'm in a worse mood. And so I'm like, okay, well, I'm just going to trade again because I'm already lost so much for the day. And then I would trade again with bigger size. And I would just kind of snowball into this huge losing day that would just destroy my account. And so, take a step back, redirect your focus, do something you enjoy. Turn your computer off if you have to. And I think that's important. Like, turn your computer off. Do whatever you need to do to just check out of trading. But again, as we talked about in the previous slides, conditioning will help. If you do this enough, then it's not going to be a big deal anymore. You do this enough, you're going to understand that, like, okay, I know I'm frustrated now, but in 20 minutes when I do something else, I'm just going to be fine. And so conditioning helps. Doing this over and over helps, and it takes time. Some of my examples of this are the gym, working out. I go to the gym, work out, jogging, playing video games, watching my favorite movie, whatever I need to do to redirect my focus and do something, I don't know if anybody's ever seen Happy Gilmore, but happy place. Go to your happy place. Best way I can describe it is, do something you enjoy. Go to your happy place. Like I said, once you do this a few times, you realize that life goes on after a tough day. And there's always the next day. And you should always try to maintain that mindset. You'll realize when you do this enough, you'll realize life goes on. It's not the end of the day. It's not the end of the world. Frustration subsides after a few minutes, and you can just move on with your day. Calculating range, something else you can do to help you kind of not necessarily get your mind right, but to condition is calculating range. If you can get into the habit of understanding the range of each stock you trade, as we have mentioned in previous classes, this should help you understand what is a reasonable risk in each trade you get into. Understanding range is key. Eventually, you won't necessarily have to kind of work it out yourself. Eventually, you'll just be able to look at the chart and kind of understand roughly what the range is. And this is really what I do. I just kind of look at the chart, see how much this stock is moving. You'll see small, like for instance, I can pull up some examples here. Let me read this and then we can go over some examples. So getting into the habit of understanding the range of each stock you trade. As we have mentioned in previous classes, this should help you understand what is reasonable risk in each trade you get into. What is a reasonable risk to take? If that range is big, use small sizing. If the range is small, you can use larger sizing. It's all subjective and up to you, but this will help you keep your losses consistent and it will help you from losing your account. Because one thing that happens when your wins and losses aren't consistent is that when you take a bigger loss than you're usually winning, you have a really big urge to double up and just to take another trade and just to, increase your sizing, and that can hurt your account. And so understanding the range of the stock is key. If you don't know what I talk about when I say range, you can just look at the previous day, maybe the current day, depending on how much time has passed since the open, and you just mark down the high and the low. The difference is the range. Like this, for instance, is from $23 up to $23.65. That's the entire amount the stock had moved on that particular day, and so the range of that day was 65 cents. Now, 65 cents is a pretty small range, and so what that means is that you're going to be risking about 10 cents. And so depending on how much you're okay with losing, if you want to lose $50 or less, you could take 500 shares if you're risking 10 cents. If you want to use $100 or less, you could buy 1,000 shares and lose, $100 with 10 cent risk. And so that's how you kind of do it, is you understand the range of the stock and you use that to determine what your share size, what your risks should be. For instance, if your reward target is 50 cents on a stock that has a 65-cent range, you might be being a little bit unrealistic. If that stock has only moved 65 cents all day and you're trying to take 50 cents, you're essentially trying to take a majority of the entire move. And let's be honest, most trades are not like that. You're not usually going to get 80% of the entire move on that particular day, 85% of the entire move. Have reasonable reward targets and reasonable risk levels. If the range of the stock is 65 cents, like I said, maybe 20-cent reward level when you're scaling out, some of the way is reasonable. Maybe 15 cents is probably reasonable. And that way you can have a reasonable expectation of getting that. If the stock has a $3 range or $3 or $4 range, and you're giving yourself, a 10-cent risk, you're probably keeping it a little bit too tight, because a stock that's moving, $4 or $5 a day, that thing's going to swing up and down 10 cents extremely easily. And so that's probably keeping it a little bit too tight, and you may want to loosen up that risk, because that can get frustrating as well. If you're giving yourself too tight of a risk and the range is big and your risk is too tight, then you're just going to keep getting stopped out.